Okay, so the recording, so that in case some people missed it, they can listen to Bala's strategy. So before we get started with Bala's strategy, let us have a very quick review of options. I hope most of you have brushed up options. I'll ask some questions. Feel free to jump in and answer. Multiple people can answer. Okay, so the first question is when you buy a call, that is called long, right? So long means buy, short means sell, right? So when you are when you have a long call, do you have a right or do you have an obligation?
You have a right.
Yeah, anybody else?
Right.
Well, you have a right, but on the day of expiry, if you are in the money, they will force the buy. So before you have the right, you don't have the
Right,
obligation to buy. But on the day of expiry, if it is in money, they will force the buy on you.
right, right. Okay. So that is when you are buying a call, you generally have a right, right? So you can buy it anytime at the exercise price before the expiration date. Okay. When you are short call, that means you are selling a call. What do you have? You have a right or obligation?
Obligation.
Obligation if somebody forces you.
Hmm. Obligation for what? What are you obliged to?
You have to you
Sell
have to
the shares.
you have to sell you what you have or what you promise that you will sell to the buyer of the call.
Okay. Yeah. So you have to sell. You have
Sell the
to
shares.
you have the obligation to do that, and so
You,
that yeah.
well, I guess you will be obligated if the price is below the price of your strike price.
Yeah. So the main thing is price. You are obligated to sell at that price. Yeah. Okay. Very good. So I think everybody is good. So Bala, you can. Are you able to share your screen?
Uh, how do I do that? Share screen. Host has disabled participant screen sharing.
No, I made you host.
Oh, okay. You made me host. Okay.
Okay.
Bala is an IT guy. He should know.
I'm going to share my screen.
Yeah.
So
Yeah, we can see it.
you will
We can
so
see.
um okay. And
Yeah.
now maybe should I share just the PowerPoint or
No, you can share your desktop because you
yeah,
want to show.
I will share my desktop and I will minimize this window so that it is
Or you can go on presentation mode, the slide presentation mode, which will be the whole screen, I think.
Yeah, you see
no, but
that
I
on
do
the
want
top
to
bar.
Oh, you want to go back and forth,
Yeah,
Bala?
want
he's
to go
going
to
to
back
jump
and forth
back and forth.
between
Yeah.
Okay.
Thinkorswim screen and this.
Okay. Okay.
Now, are you guys able to see my
Yeah.
screen?
Go to the next slide.
Yes,
The
we're
font
able to
was
see it.
Yeah, we can see it.
yeah.
Okay.
Yeah, it's
No,
clear enough.
we
I
can
think.
read it.
Yeah.
Okay. I'll start with the Happy New Year. Happy New Year to everyone.
Happy New Year.
You too.
Happy
You
New
too.
Yeah.
Year.
Yeah. See, I'm going to take it as slowly as possible. But in the meanwhile, if you have any questions, do not worry about interrupting me. Just go unmute and interrupt me anytime. I will try to recover from the and try to answer the question. Today, I'm going to talk mainly about my strategy, what my strategy is, and what the objective of my strategy is. But I'm also going to cover a little bit about Greeks. There are options Greeks, which are many. There are about 10 of them. I'm not going to talk about all of them. I'm going to talk mainly about delta, theta, and gamma. These are the three Greeks we will talk about today. And out of which I will focus mostly on delta because my trading strategy is based on a delta basis. So I will come back to these three slides as we talk about the strategy and I will try to explain what those slides are. Okay. And I just want to give you a quick rundown of what options is, just in case somebody doesn't know. In the late 60s or early 70s, the two professors, Black and Schultz, out of Princeton University, they came up with this mathematical derivative concept. And that's what they were eventually given Nobel Prize on economics. They came up with this brilliant idea of options, and they came up with this mathematical theory. I'm capable of explaining all these theories to you, but these are all the Greeks that are there, and it's based on two concepts. Now everybody knows about the stock and the stock price. Every day we buy and sell stocks. So typically in a given day, about 1% of the outstanding shares of a company gets traded on the market, between slightly less than 1%. Sometimes it's a little bit more, but most of the time it hovers around 1% or less. So believe it or not, even though we say stock price is XYZ, it only is 1% of the people buying and selling at that price. The other 99% of the people are just keeping quiet and holding the stock. So if all 99% start selling, the price of the stock will be much different than what 1% is selling. So the whole concept of stock market is, as you all know, it's when a small fraction of the company is sold from person A to person B. Now, this options theory introduces two additional concepts. One is what is known as a strike price. As you know, when you buy a call, if the stock price is say $100, you can buy a call at $95. So at $95, you want to buy that stock. So somebody will charge you, okay, it's now selling at $10. You want to buy it at 95. You should be able to get it for $5, but they will say, I am not going to give you that option to buy at $5. You got to give me $6 or you got to give me $7 in order for you to get the option to buy at 95. So he takes $2 of premium. You pay $7 for the option to buy at 95. So that is what is known as a strike price. The strike price varies up and down the stock price. You strike, if the stock price is $100, strike price can be as low as $70, maybe even $60, or as high as $120, $130. For each of those strike prices, there is a corresponding price of the option that the buyer and seller comes up with. In this formula, there is this fair value, which is a big calculus equation of calls and puts. There's a fair value that is calculated. That fair value is basically a derivative of stock price, strike price, and the third variable called expiry date. So whenever you are given an option to buy at $95, you are given some amount of time, maybe a week, maybe a month, maybe 2 months, maybe almost a year sometimes. So you are given a varied amount of time period by which time you have the option to exercise that call. So the two big variables in addition to stock price are the strike price and the expiry date. Those are the two things. Remember those two things, they are going to come very much handy in the strategy. They are the ones that determine some of the values. So the main thing is there are a lot of values here. I'm just going to read them, that's all. Delta, vega, theta, rho, lambda, gamma, vara. You just go down, there's a whole bunch of options Greeks, which are all gobbledygook for us. It's all big calculus. We don't have to worry about any of those things. All those things are already calculated for you, and they're already put out by the platforms such as Thinkorswim. I'm going to use Thinkorswim platform to explain my ideas today, but you could use any platform. Almost all the platforms will have delta, theta, gamma, those kinds of variables will be described. So that is about the basic formula. Okay, let me go to this slide. The value of the option depends on these 6 variables. The 6 variables are stock price, strike price, expiry date, and there is a concept called implied volatility. As you all know, volatility is how much the stock is jumping up and down. That's volatility. Implied volatility is what is used to calculate option price. Implied volatility is simply projected volatility based on historic volatility. So basically, because you have to have if you want to set a price for an option 1 week from now, you don't know what the volatility will be 1 week from now. So you basically have to project it. So that's why it's called implied volatility, not historical volatility, because the history has not yet happened. So history is still happening. 1 week from now, we all don't know who will be president. So it's like that. So there is a percentage of probability or all those things. That's why it's called implied volatility. And then the regular other 2 variables are dividends that may be issued by the company, which will only go to the stockholders. The dividends will not come to the option holders. And the interest rate generally in the market also affects the options price. So some people will often wonder, what about dividends? What happens to dividends? Who gets the dividend when you buy a call? What happens to interest rates? Whether interest rates will be useful or not in the whole thing. I want to tell you, all these 6 variables are in these complex formulas. They're all in there with all these calculus. Based on all those things, the calculations are made, and those calculations are automatically provided to you. So you don't have to worry about anything I said. You just have to follow the screen that is in front of you. So that is the basics, okay? Now delta, let's just take a look at delta quickly, so that because we will be using that quite a bit. Delta varies from 0 to 1. In some cases, it is defined as the probability of the strike price being in the money on expiry date. So for example, let me go back to the screen. Now I'm using SPY as my thing here. Let's say 15th January. Now we are on 12th January. 15th January is 3 days from now. And let us say today's price of SPY is 378.77. Let us say that what will be the probability of that price being 376 or above on 15th of January is 70%. So the delta for that particular position, which is 15 January expiry, strike price of 376, delta is 70. Now it just changed to 69. Okay, so do you follow that? You have any questions about that so far?
So delta is same as probability.
Well, delta is more than probability. Probability is one of the factors. Delta has multiple meanings. I will go through them. Let me give you another meaning. Basically, what happens is, in options theory, there is an idea called what stocks do you own, kind of. So, for example, here I have executed a trade on which expires on 21st January 22. Are you able to see that at the bottom?
Yeah.
And,
Yes.
and the strike price is 275, and that's a call I have bought. I have paid $104 for the call the other day when I was showing the screen to someone else. I bought this. This is a simulated trading. And today's price is 109 for that. And today's delta for that is 86. So what that means is I technically, mathematically, I own 86 shares of SPY, which is nothing but probability of the strike price being above 275 on 21st January 22 is 86%. Sometimes it is computed as how many shares you own mathematically. So sometimes we use the delta to come up with a mathematical position of your stock holding. So it is just mathematics. That's all it is. So it has got a mathematical meaning as well. And there is another meaning that they use for delta is typically if the stock price moves up by $1, your option price, which is the mark here, will move up by 70 cents. So 376, the mark is 4.275. Actually, you know what, I will use a theoretical price for that. The theoretical price for that is 427. Okay, that is the same as the mark. So the price calculated, you know, somebody asked this question earlier, you know, what is the option? Is there a price for the option? The fair value of option is actually a mathematical formula. Based on that, this theoretical number 427 comes about. So the point here is, if the stock price goes up from 378.77 to 379.77, the theoretical price of this option will go up from 427 to 427 plus 71. So that is another meaning of delta. So the delta has multiple meanings, but mathematically, let us understand that as a probability, a movement, and what you hold theoretically or mathematically, it's all rolled into this delta. The delta,
Are you essentially saying that if the actual price of the stock goes up by $1, the option will not go up by $1, it will go up by 71 cents or whatever you showed?
yes.
Okay.
So what will happen is, if the price of the stock goes up from 378.77 to 379.77, the price of your option, this particular option, will go up only by 71 cents. However, if you look at this option where delta is 1, 367, expiry date 15. So if you hold this option, 367 on 15 January expiry, if you hold that call option, then when the price goes up by $1, your option price, which is 12.19, will go up by a full dollar, because your delta is 1. You follow?
So Bala, when you say the option price, which also means the premium, right?
Premium, yeah, option price is the, well, some people call premium the difference between the option price and the inherent intrinsic value of it. So the extrinsic value is probably, some people call extrinsic value as the premium that you are paying to buy that, but you can also call it options premium as the options price. That is the price on which you trade that option. Yes.
Okay.
Yeah, that is a net outflow or inflow. So just one thing, if we are thrown out of Zoom, I will restart the meeting. Please join the same Zoom. Okay. Yeah, thanks.
Okay. So do you follow now? Delta is like that. So the at the money. So here you see these shaded areas here from 1 to 52. These are generally called in the money calls. And these are out of the money calls, these black ones. And almost most of the time, 90% of the time or better, the 50 delta will be at the money. So typically on any expiry date, it will be 50 delta, it will be there or abouts, maybe 52, maybe 49, but at the money, it'll be around 50 delta. Okay, that is basically delta. Okay. Now, can we move to the next Greek? Any questions on delta?
No, I think delta is good.
Okay. Now, the next one I will talk about is gamma. See, in this, are you able to see this little graph here?
Yeah.
So the gamma is something that I don't use in my strategy too much, but I do watch for gamma. Gamma is the rate of change of delta. So what happens, as you saw in the screen, at different strike prices, the delta changes. At 379, delta is 52. At 367, delta is 1. And the delta changes between 379 and 367, which is only like $12. Within a $12, delta is moved from 52 to 1.
It's like
So,
velocity and acceleration, something like that, looks like.
yeah, it is. There is a little bit of an acceleration. So here, the rate at which the delta moves, like for example, if you look at it here, from 379 to 78, delta moved from 52 to 59. Whereas 369 to 368, delta moved only by 4. Here it moved by 7, here it moved by 4,
Exactly.
0.04. So the rate generally varies. It goes, those who are kind of open to a little bit more mathematics will follow. It will follow this curve. So we are now in this mode, 50 to 1. Rate of change is higher and then goes down. So as you can see, this is gamma on the other side. We are on this. Are you able to see my cursor?
Yes. Yeah,
Okay.
we can.
Yes.
At the money is 50 delta. From 50 delta, it goes up, the delta goes up like that. And gamma will start higher with the rate of change of delta will come down to 0. Eventually, as the price moves up, stock price moves up, delta won't change, delta will remain the same. And when it touches 1, 1 is the maximum. So if 367 is 1, 365 is also 1, and 363, 263, everything is 1. At which time gamma is pretty much 0. So that's why gamma has become 0 here. The reverse happens on this side of the equation. If you look at it at the below here, from 45 it goes down to 0, delta goes down to 0. So the rate of change for $1 here is almost faster, 45 to 37, but 389 to 90 is practically nothing. So 390 to 91 is 1. So this is the basic mathematical formula by which it moves. So the rate of change of delta is gamma. So there are some optimal positions in your trade that you got to keep for gamma. So if you keep an optimal position for gamma, that is good. Typically, gamma has to be slightly negative. That means if the stock price moves down, your delta position will actually go up a little bit, even though stock prices move down. That's a very optimal way of looking at things. Okay, any question on gamma? Gamma is a very simple one. It's just a rate of change of delta. That's all it is. Now, theta, let's come to theta. Theta is very important. Theta is basically time decay. So let me go back to my screen again here. Now, I have put what is known as the extrinsic value here in this column. So you take the same option at the money, the extrinsic value is $995, almost $2. So here, look at this. The strike price is $379. 15th of January, we are going to expire. That the market is asking for $2.24. That is a good $2 more than it is worth, because the price is only 378.77. So only 23 cents is in there. The rest of them 26 cents. Only 26 cents is in there. The rest of them are all extrinsic value. That $1.95, 90, now just changed 965. $1.96 is what is known as the extrinsic value. Now this extrinsic value reduces like $1 if it goes down from 378 to 379 to 378, it drops from $1.96 to $1.57. Now that at that point where you are, the delta, the theta of that is almost 40 cents, 39 cents. So that much you will lose if the price drops by $1. So not only if the price drops by $1 from 379 to 378, not only you will lose the value by that 52 cents, because that dollar delta amount will you lose 52 cents there, but your theta also will drop by about 40 cents. So you will have a double whammy there. So basically theta is what you lose for, it is generally known as the time decay value. So as you approach expiry date, the theta will change. In this one, I cannot see that in this one because this is on a given expiry date. But let's say, for sake of argument, let's imagine we'll open up the next one. You see that when you are 7 days out, so when you are 7 days out,
Somebody has to mute their phone because it's echoing.
okay. All right. When you are 7 days out, the theta is $2.69. I mean, not theta, the extrinsic value is $2.69. But when it moved by, if it moves by $4, nothing has changed. The price is still $379. The value has dropped from 270 to $2.03 here. So in 4 days, you have lost 70 cents. And theta is the money you lose every time you go towards expiry when you buy a call option. So for example, if you buy a call option of 379 in 3 days and you paid 224, and in 3 days time, the price of the SPY does not change at all. It remains the same. You entirely lose these $2.06 in 3 days time. You will simply lose all of it because the theta is your time decay that works against you when you hold the call, when you are long on the call. If you're short on the call, that becomes your money. That's what we are talking about in covered calls. When you take a covered call and you sell it for $2, and if it goes down to the stock price doesn't change, you get to keep that money because the time decay value becomes your value because you sold it. You are short on it. If you're long on it, you lose it. But that is basically theta. Okay. Now that I have kind of covered the basics here, let me go to my strategy. Okay. I'm going too slow, so let me speed up a little bit.
No, I think you're going in the correct speed. That's good.
Okay, good. Now let's go to how do we use this in a strategy.
Can you go on mute, please, others? Because I'm hearing some noise. I'm sorry.
Okay. So let us go to an investment objective. So I am going to go over SPY as my instrument here. You can use it on Amazon, you can use it on Google, you can use it on Tesla, you can use it on any stock you like. But what I have put together is a strategy that will work for SPY. The idea here is that when the stock moves about 10% in a year or more, 10, 20, 30, something like that, in that range, if the stock moves, I want to make 100%. That is the objective. How do we do that? Using these deltas and gammas and thetas, you can do that. That's what I'm going to tell you. It can significantly enhance your return just playing this SPY. It is nothing more than basically taking covered calls, but it is a little bit more mathematics than just taking simple covered calls. So we will go over them. And if you pick a stock which is highly volatile, like TQQ, you can make a lot more money. It is a higher risk, but there is higher reward. So typically you want to pick a stock which has got some level of volatility. If there is no volatility on the stock, like a utility stock, you won't make any money out of this strategy. For this strategy to work, there's got to be a little bit of volatility. The price has to go up and down. I will show you how it works. Okay. So, okay, we just talked about the power of delta. That's what it is. Call options and extrinsic, and we are going to use, okay, this is what I have been talking about, extrinsic value and intrinsic value and diagonals. That's what we've been talking about. This is what the strategy is. This is the only slide that you need to worry about. So we'll spend a little bit of time on this slide. The first strategy is to buy what is generally referred to as stock replacement strategy. It is not a full stock replacement strategy. Originally, when the stock replacement strategy came up, it is buying leap options at 1 delta. That is technically the stock replacement strategy. But what I am going to talk about is buying it at 85 delta. So for example, you spend about $100 per share for one option of SPY, about 85 delta. Here I'm at 86 delta, which is fine. 1 year into the leap, so I go all the way down. My position is on 21st January. Okay, I cannot see that because 275 is not there. So I'm going to go all and I just want to show you. See the 275 option, it shows 85 delta here because it is 8674. It is rounded out to 2 digits, 87. And it's about $100 I spent, $104 I spent a few days ago. So that is the investment for one contract, which is 100 shares at about $100 investment you will make. If you are 1 year out at around 85 delta, you go and locate the long option at about 85 delta, say 275. 1 year out, say January of 22, you buy at, you invest about $10,000. So that's step one. You do that, then you have now a long position against which you can collect premiums. Now, the next thing you do is you collect premium on a weekly basis or every other day. You sell covered calls against that at about say 35 to 45 delta. I'll show you Let us now come back. I will use 25. Let me come back to say 15 January. I will use this one 381. I will sell 381 for about $1.27 against that. So current price is 379, 378 something, and I'm going about $2 more, and I'm selling at about 35 delta, and I'm collecting $1.27 as my premium. The thought here is in 2 days it will probably not cross this. Sometimes you can be aggressive and take $71 at 43 delta. If you think the chart, now this is the time to read the charts. So if you think the charts are in your favor, it is in the top end of the Bollinger Band. This is the full technical analysis I don't want to go into right now, but you have to pick your time to sell your 35 delta versus 45 delta. Most of the time go with 35 delta. It will be simple. You will collect $1.27. Sometimes if you think the market is going to go down and you are smarter than everybody else, then you sell 45 delta. Some days you feel you are the smartest guy in the world, sell 45 delta and take $70 something. Otherwise, just stay with 35 delta. So the idea here is every 3 days, you can collect this $1.27 out of this position, technically. And if you are able to do that every 3 days, over 365 days, that's almost more than 100 days, and you will collect more than $100 out of this premium alone. And $1.27 is what 12,000 some dollars you will make out of this. Now, if the price of the SPY goes up, let us say, right now it is 378, and now the prediction is it may go to 4,100, 4,200 is the prediction for S&P 500. So this may be 410, 415, 420, something like that. And if it goes to 420, let us say by January 22, then this will be worth, let me do a little calculation there for you. You go back here, and if you put
47,
the,
probably 155 something.
so let us say it goes up by about $40. So you will make about plus 40, right? So there's a way to do this. Okay, I don't know, for some reason it's not working here. But if you do this, the theoretical price will calculate and tell you that. But anyway, you know that, which is if it goes up by $40, your price will go from $100 to $140. So you would basically make about 30%, 35% on a 10% move. You will make about 30-35% on the long call, and you will make about 60 to 70% on your premium, because not always the premiums will be collected. Sometimes the premiums will work against you when the stock moves higher than you expected. So you sold it for $1.27, but by the time 15 January comes, if the S&P goes to 382, then you would have to roll it to the next days. So you have to sell it. It will become now worth almost $1.10. You would collect only 17 cents. So you have to pay $1.10 to buy it back. But then you can sell the next, roll it to the next one. So every 3 days, every 2 days, you got to mark your calendar, spend 10 minutes on this trading screen and roll it every 3 days. You keep on rolling it. About, I would say, third of the time, to 40% of the time, you will collect the premium. The rest of the time, you will have to roll it up and break even. So you will collect about $60 out of the premiums, and you will collect about $30 out of $30 to $40 out of your long call. When it goes up by about 10%, that gives you 100% return. That is the simple strategy.
Bala,
Bala, one
question
Bala,
for you.
Bala, you keep saying collect the premium. Does that
Yeah.
mean you are writing a call rather than buying a call?
Yeah, you're writing a call. When you write a call, you collect this dollar. I said $1.27 in this case. So you collect $1.27 is your money. If on the day of 15th of January, if the price of SPY is less than 381, let's say it's 380.50, then it will expire out of the money, and it is expire worthless, and it will become your money.
And I understand that, but the whole presentation you made on the strategy is all for writing the call, not buying a call.
No, it's
No,
a
no, you have to
combination,
buy
right?
the first call.
First you have to buy a call, which is deep in the money, and then start selling the call with the 2 days to 3 days expiration.
Yeah.
Yeah, I have a question on that, Bala. Like if you buy a long call, and so that is about a year out. Now that doesn't really give you the stock until then. So how can you how can you sell calls based on what you have bought as an option?
You can, because level 2 trading in Thinkorswim allows that. You don't have to have a stock to sell against it. You can have an option, and you can sell against that as well. I meant to show you guys this, but today I didn't pay attention to my simulated trading, and it forced a transaction on me. So I'm negative 100 shares here because it closed at 370. I had sold at 377 when I got into this position. So I can actually get into a diagonal. Like for example, I will get into a diagonal right now. Let's say I buy a diagonal. So now I'm buying, let me show you how it works. So January, say, I'm going to say 275, right? Let's say 275. So I'm selling one call. Let's say keep it to 1. So I'm selling one call on 15 January, and I'm buying one at 275 for $108. So 86. Okay, I can even buy it a little bit lower, but it's okay. Let's say I invested $10,800. Now I will be allowed to put this diagonal into play. So now I will be, now it's not, the market is not open, but I'm selling the 15 January call for 381 for $1.27, and I'm buying the 21st January 22 call 275 for $109, and that is allowed.
So like if you're buying the January 275 call, then essentially on that date, I mean, essentially the stock will be in your account, right?
If you don't sell it, my suggestion is before that happens, before that position, see, let us say that you're working till, let's say your tax year ends in December. I usually go in the beginning of the year, I go over the next year to January so that I have the tax option. So 30% of my return is going to be pushed out to next year. It'll be better for me tax wise.
Right.
I will do that. That's why I do that. But On December itself, if I want to take all the profit in this year, in December itself, I will sell that call. I won't even go wait till January. I will sell the call in December, close out the account, pay the taxes, and spend the remaining money.
Mhm.
So, Bala, one more question. So in that example, right? So let us say that you got busy and you forgot to roll over before the expiration date. Can you
Yes.
explain in detail what will happen?
Okay, then you will be assigned that 100 shares will be assigned, and that $377 300. So you will have that $37,700 in your account.
Okay.
So you just use that money and pay the remainder and buy it back. You have to buy that 100 shares back. So you buy.
Bala, when you say assigned, that means you actually bought and sold and you got the cash, correct?
Yeah, you sold and you got the cash.
You sold.
For the stock. Okay. Okay.
You sold without having the stock.
Right,
Without
right, right.
having the stock, you are in a
So
negative.
it's like a naked call.
Naked. You are in a naked position because you didn't pay attention, like I didn't pay attention today.
Yeah.
If you don't pay attention, that's what will happen.
Right.
So if you are in the money, you can set up alerts in Thinkorswim that if on expiry date, if you are in the money, send me an email, and you can get an email and you can make attention to it.
Right, right. Okay.
I didn't do that for my simulator. I do have that in my real trading desk. I do have alerts.
Is there an automatic rollover or no?
No, you have to manually roll. What I'm saying is not automatic. Maybe some of the professional traders will have derivative algorithms to do this, and they will do this completely algorithmically. And some of the people who make money in the Wall Street, they have sophisticated computers. I mean, whatever I'm saying is just a computerized strategy, right? So potentially a software program can be written to do this, and it can just run on your computer all day long and all week long and execute it. Some people, for example, I have this principle also. For example, if I sell something at $1.27, if it comes 90% of the profit is already there, if it becomes valued at say 17 cents, 12 cents or 15 cents, so 80 to 90% value is already gotten, I will roll it even before it expires. The reason for that is normally the expiry dates are on Friday. So on Friday, if you go and get your premiums are actually calculated for Saturday, Sunday also, even though they are not trading day. So sometimes it is actually, even though Fridays are usually expiry dates on weeklies, it may be beneficial to roll on Friday rather than wait till Monday. You will get the premium for Saturday, Sunday also. You just have to, I mean, this is going to take a little discipline and follow the formula, follow the techniques, and you just have to keep on doing this, and you will get your own little balance. You know, sometimes you may be happy with the SPY, sometimes you may want to look at, say, for example, I want to tell you one more thing here, which is important. See, you see this number 18.93%. and 14.27%, and all the 18.31, 20.19, all these percentages. These are what is known as implied volatility. So those are the implied volatility numbers. So the higher the implied volatility, the higher the premium normally the market gives for that. So on SPY, the implied volatility is around 20% usually, 16 to 20%, which is fantastic. You can make good money on this. But if you go to a stock like TQQ, for example, look at this. Implied volatility is 69%, 70%, 80%, 90%, like that. These guys jump around like crazy, and the premiums are very juicy. For 3 days on TQQ, the premiums are as high as $4, $3, $2 like that. Whereas on SPY, it was only $1.27 like that. So you can go to some highly volatile stocks and play the same strategy and see what works for you. Sometimes you may want to be a little bit more conservative and play 30 delta. Sometimes you want to be aggressive, play 45 delta. Where you sell this is actually an art. There's no particular science to it. You can just play with it and see what you feel comfortable with. But a lot of people out there, and the algorithmic traders, the hedge fund operators, they do these kinds of things to augment their hedge fund returns. And they will do that towards the end of the year to keep their returns up and to get more fees for themselves. They do all kinds of tricks like that. But you don't have to write a program for. I don't know how to write a program for this, but this can be done manually, and you don't have to spend more than 10-15 minutes on your trading desk every 3-4 days. You don't have to do that. And if you're not comfortable doing it every 3 days, take a weeklies. Don't take 3 days out. 3 days out is available for SPY. For example, on TQQ, only weeklies are available. Google, only weeklies are available.
Bala, I have a question.
Yes, please.
On the, when you decided on buying a call at 275 for
Yeah.
SPY, what was the basis of 275? Can you explain that again?
The basis of 275 is a magic delta 85. So the principle is this. The whole idea is normally what happens is, if you buy a stock, then you hold it, right? And the theory behind 85 delta is 85% is good enough. Between 85% and 100%, there is not enough of a difference in terms of making money. So in order to increase your return, normally when people make covered calls, they don't really make a lot of money, significant amount of money. It's just pays milk money. That's all. To buy milk, that's all the money they make. It's not really a significant amount of money because the base of the stock is 100%. Here, 85% of the stock you have bought for about 25% of the value. So what you have done, the value of the stock is 377 and 378.77, and you are buying for 109, which is about, say, 30% here. For less than 30%, you are buying an 85% equivalent of buying a 275 for a small premium of about $4. You are able to get that. So idea here is you spend less money to be in a position against which you can do covered calls to enhance your return. This you cannot do for all of your portfolio. You do this for certain portion of your portfolio to increase your return on investment on this in this position. So every position is a hedged position. You are hedging between 275 and 381, which is 85 delta versus 35 delta. So net of 50 delta will be the net. So the idea is you have a net of 50 delta, which is half the stock, but you have spent only less than a third of the money. So about 25%, maybe 28% you have spent, and mathematically you now hold half the stock for that, and you are hedged between it going up and going down. When it goes up, you make money on the long call. When it goes down, you make a little bit of money on the short call. So you are hedged. So this 275 is nothing magic about it. It is just a position on which it is somewhat equivalent to holding a stock. That's why we call it stock replacement. Did I answer your question?
You did. Thank you.
Yeah. So
So,
Bala,
so
basically,
essentially, like you're holding,
yeah,
I mean, with that 275 call, I mean, if you don't do anything like, that will actually, no, it won't come onto your account, right?
No, it
Because
won't.
it's much lower than the price.
No. This is going to wait till January of 22.
Oh, 22, yeah.
For a whole year, nothing will happen. It will just sit there. Now, sometimes what will be a smart thing to do is to roll that also. For example, if in say 2 months time, 3 months time, suddenly the stock jumps from 378 to say 388 or 395 in 3 months time. If it jumps quickly, the delta position will become much higher. So what will happen is technically, let's say $12 it goes up. If it goes up by $12, um,
Be
the delta
390.
position, let me go here, okay? The delta position, okay, that's important. It's a good point I wanted to make. So if you go here, you are in this position of say 275, you are in this position. Now, suddenly if the delta moves up, I mean, if the stock price moves up from 378 to say 390, your delta position will go from 87 to more than 90.
Mm.
Okay, then you have the option of rolling it down to 85 and collect some money out of that position. You can
Okay.
also collect money out of the long position.
right.
So that way you keep it optimal at about 85 delta. I wouldn't do it just at 90. If it really goes north of 90, 92, 93, like that it goes, then it becomes a little bit not so optimal because you have so much money stuck on this, which you could have used for other strategies. So you come back to 85 and you continue to play the strategy. If you still think SPY is going to keep going up, now if it comes to a point where if you think the SPY is not going to keep going up, it has already reached maximum and it is now going to go down, something has happened, like that, you just completely sell everything and get out of the position or get into a new position in some other stock. And that's when you should probably look into plug power or QS or something like that. And this strategy is mostly for established companies. This strategy, don't apply it for QS or plug power or even Tesla. I wouldn't use this
Right.
strategy for that.
Like volatile stocks.
Yeah. So Bala, one more question, right? So when you are selling the call, that
Yeah.
does not mean until the expiration date, right? Even you can get exercised even before the expiration date.
Sometimes it will get exercised.
Yeah.
In SPY, it will not get exercised that easily because
Okay.
SPY is highly traded stock. Normally in a stock like Google or Amazon, it will get exercised if there is a dividend involved. In Google, Amazon, there is no dividend. But in Apple, for example, if you play this strategy on Apple, and if there is a dividend that is going to be issued,
Right.
and you have a short call, somebody will exercise just to get the dividend.
But SPY also has dividend.
I don't know if SPY has,
Yeah.
SPY.
SPY has 2% dividend.
Okay, so you have to be, is there a date in which the dividend is assigned?
Yeah.
Okay, let me just go to the charts. Okay, they don't give me the dividend dates here. Normally, you have to find out SPY. Do they have dividend dates or do they just issue dividends without a date?
Maybe if you increase the the time scale, you'll probably see that.
Okay. On 3-year chart also, I don't see
Yeah,
it.
it's not.
Normally you'll see the dividend. Like for example, if I take IBM, for example, um,
Bala, it's anyway only 4 times a year.
it's
Yeah,
only
so the last
Probably
one
say
was on
IBM
December 20.
Yeah.
So December 20, September 18th, those are all the dividend dates.
Yeah. See, typically I would say you have to watch out for dividend dates on which date you may get called on. So you can set up alerts for you if there are dividend dates. I don't know whether SPY may have dividends, but maybe the dividends are rolled into the price of the stock itself, Nari. I don't know.
No, I think.
They actually give
They
you a
do.
dividend on
Yeah.
date. Okay.
Maybe in the simulations it doesn't show,
Okay.
Bala. I have a couple of other questions, Bala. I mean, essentially, like if you're doing, multiple transactions like these, put and call options, I mean, how do you keep track of them?
I mean, just comes on your position. See in the monitor,
Unika?
yeah, it shows you all your
So
positions.
like you have to review that on a frequent basis. I mean, essentially for you to keep track, right?
Yeah, you see, you have to have a trading discipline.
Yeah.
So let us say you have some time every 2 or 3 days or every day for 15-20 minutes at 2 o'clock in the afternoon. You have to develop a little schedule
Yeah,
when you look at this.
right. The other question I had is like, I mean, essentially you can place option orders, extended market time, but they don't really, they don't get assigned or executed, right?
No, yes. They only during only market hours the options are traded. Yes.
Yeah.
Sometimes what happens is I got lucky actually. On remember one time Nike last year towards the year end, Nike went crazy, and I had a position which I should have been called on. They did not, even though I sold it at 141. The price was more than 141. It was 141.50 or something.
Hmm.
50 cents. Somebody should have done the transaction for 50 cents. They did not.
Hmm.
And I got expiry on the thing, even though the price of the stock was higher than my call price. I never was called on it.
Hmm.
It can happen because towards the end of the day, when things go crazy, even the market makers miss it. I got lucky
Yeah.
on Friday, and my short call didn't get called. And then I got even more lucky that after the thing, Nike announced some big announcement, the stock went up like $6, and I got all of it on my long call.
Yeah.
So, but typically it is imperfect, but most of the time, around 4 o'clock, they would close out the deal. If you are in the money, you will be called on. That's what will
Right.
happen.
Yeah.
So Bala, a quick question now.
Yes.
So when you say you're doing so you're buying 85 for 1 year long term, right? And then you're selling 35 delta every 3 days, right?
Yes.
At $1.27. So you are betting that they will be out of the money. That's why you'll collect the premium.
Yes.
Yeah, okay.
But one thing I would say, Bisham, one idea that I would like to say is like this. See, watch the charts. If you are into technical, watch the chart rather. So for example, if the chart will tell you whether the next few days is it is going to be a downward trend or is going to be upward trend. See, as you can see the channels here, I put the Bollinger Band here, and as you can see, I mean, this is the COVID time, so that is unexpected, nobody knows. Then during steady days, it goes to the top of the band, it comes to the bottom of the band, go to the top of the band, plays around there, comes to the bottom of the band, like that. Every so often it switches back and forth against the mean. The mean here is a 20-day mean here. You can use a 20-day mean or 50-day mean or whatever you are comfortable with. Now, if the stock is say at this point, then I wouldn't sell aggressively even at 35 delta. I will just wait for it to recover a little bit because it has touched the bottom of the band. You know that the stock is going to go up the next couple of days. You just next couple of days, you wait it. Once the stock goes higher, then you sell at 35 delta here.
So
Now,
which means you're saying that if it reaches the support, then you won't sell.
if it reaches the support, don't sell. If it reaches the bottom of the band, don't sell. Wait a couple of days before it gets off that, and then you sell. This is where the timing of your sale has to mean something. So that's why in the formula, I'm only using about 1/3 of the time you want to win. That's enough to get this 100% return.
Oh, okay. So so the green and the pink are the Bollinger Bands, right? The green is the top, pink is the bottom.
Yeah, here red is the top and
It's not
Or
green.
red and pink, red and the pink, right?
red and yeah, whatever.
Purple.
Yeah, purple, yeah.
Red and
Red
purple.
and purple.
The green
Purple is
is
the
the
bottom of the
moving
band.
average.
And this is a 20-day moving average that is in the middle. So I will watch this. If you are on the top of the average, then you can sell. Like if you are here, you can even sell 45 delta and collect more money. If you are here, don't sell. If you are here, sell 35 delta. So where you sell 45 delta, where you sell 35 delta, you can look at the charts a little bit. So that will help you.
So this is a Bollinger Band for how many days? 20 days, right?
I have put it here for 20 days. I use it 20 days. I use sometimes 50 days, depending on how much trigger you want. 20 days will give you a trigger every 20 days. 50 days will give you a trigger every 50 days. So how much trigger do you want is the only question. I mean, that's technical, I'm not talking about technical today, but you can follow technical support levels, trends, Fibonacci series, stochastic modeling, whatever technicals you follow, you can follow that for this also.
I think, I mean, essentially, as the stock price varies, for calls, if the stock price is going up, generally for calls, the premium would be lower. And for puts, if the stock price is going down, then your premiums would be higher.
Well, I mean, you're talking about option price or stock price?
It's our option premiums. Yeah, it's option premium price is based on, the stock price, right?
Yeah, it is. At the end of the day, Gopi, I would say it is based on what the market is paying. So at the end of the day, somebody has to buy what you're selling,
Right.
or somebody has to sell what you're buying. It is still at the end of the day, there is a buy sell going on. So no matter what the theoretical formula is, if there is no buyer for that, there is no market for you. That's another reason why I suggest you guys play with the SPY, because there are always a lot of buyers and a lot of sellers for SPY. And because the volume of SPY is so high, it is almost sure that you would get a trade which is appropriate to the calculations. So whatever you are saying, calculations will be true only if there is a buyer. Sometimes in this trade, like for example, you are trying to buy a 275 1 year out at 85 delta, you may not find a seller. Nobody wants to sell it to you. That means you can't buy. You may have to wait a whole day to find a seller for that.
Right.
Bala, isn't there a relationship between the option price and the volatility? That when the volatility is high, the option prices are high?
Yeah, that's what I was trying to tell you guys. See, the option price is a combination of all these factors: implied volatility, expiry date, strike price, stock price, dividends, interest rates. All of these play into the option price. But in addition to all of these things, you also have to find a buyer and a seller for that price for the transaction to take place. So
you have to look at open interest.
You have to look at open interest. You have to look at
Volume.
transactions that are going on, and those things also are important. But if you pick SPY, for example, there will always be open interest for SPY at all levels, because it's a heavily traded ETF on Spider, on S&P 500.
Is
So
this
Bala,
true
if you
for QQQ also, Bala?
I follow TQQ. TQQ is a little bit more riskier. I follow TQQ. I also follow QQQ. QQQ is somewhat similar in parameters to SPY. See, you will see this QQQ implied volatility is around 2024 like this. So QQQ is also pretty good. You can do the same strategy on QQQ also. If you are comfortable with technology, you can do QQQ, or if you want to take a little bit more risk, you can go to TQQ.
So Bala, if you do this with TQQ, you'll have to do a shorter duration, not a year.
Yes, I would suggest that. I would suggest a much shorter duration on TQQ, because
Which is what, 2 months or?
Yeah, 3 months, 3 to 4 months. I wouldn't buy leap on TQQ. I will buy maximum 6 months. I'm now playing TQQ on 6 months. So I wouldn't do more than 6 months on TQQ, because
So first so basically a covered call, buy 100 TQQ and then do the covered call, right?
yes, the premiums will be more juicy on TQQ.
So Bala, is there a professional service that somebody can provide for this while we are playing in the learning mode?
I want to tell you, I don't know whether you guys watch CNBC. There are two brothers who comes there, John and Pete Nigerian. And they are the ones I learned, not from them, from their school. A lot of these strategies that I talked about, I learned from they had a school, institute or something like that. And I learned from one of their teachers called Ron Ianeri. He's a great options teacher. I learned from him. He passed away recently. He's a great guy. They have some service, I believe.
Yeah, actually TD Ameritrade has a free service, right? So you can call them. They have one-on-one coaching.
No, they only have educational service. But what Dharmendra is asking is about somebody who will do this for you kind of service.
Professional help. Yeah.
Right. In other words, if let's say, you would think professionals are, as you say, they have software, they have computers, they're ready to go, they're doing it, they have people that are monitoring it. Timing wise, they probably can execute it much nimble.
No doubt about it. there is a hefty price for it. Like for example, there may be hedge funds there which do this. They want your money and they will ask for 7-8% premium
Right.
that they will take, and they will guarantee you some level of return, and they will, they will probably give you S&P returns, and then take 20% of the profit on top of it and charge you some fees to manage it. Like hedge funds like that are there. I am not aware of them directly,
Okay.
but I am sure they are out there, a lot of them. That's how they make money, the hedge fund guys. They make money on somebody else's money like that, and they also get return. I mean, I have some investments in India. I do it like that. The 2 or 3 funds on which I have invested in India, where the pros there, they do everything. They give me some benchmark return, and above the benchmark return, they take 15 or 20%, and I get 80%. Above the benchmark return, and then there is a fee on top of it that I pay. I do that in India. I'm sure there are many companies like that here also.
Yeah.
And that's purely for option?
No. That is for everything.
Okay.
If you see the movie Wall Street, they go all over the place for that. I mean, what I'm talking about is more like a little bit of a fun. And
That's right. Exactly. It's more fun.
Yeah.
It's also, when I was in school, there used to be a guy